Hi guys, welcome. Qualcomm and Skyworks Solutions have both reported their quarterly earnings the past week, and both have reported good revenue and profits. But let's say you can only invest in one, so which one would you choose to buy? In this video, I'll be doing a side-by-side comparison to see whether is it Qualcomm or Skyworks Solutions that win the investment. So let's jump into it. Let's start with the growth metrics. Qualcomm is in blue and Skyworks is in red. Here's the quarterly revenue chart going back to 2017. Both companies' revenue has grown in this period at about the same pace. The year-over-year revenue for both stands at around 52%. So both score a point each. I'll keep the scores and tally them up towards the end of the video. But both companies don't score a point for quarterly revenue as it has started to dip. You might be wondering how come Skyworks' chart is so short compared to Qualcomm. Qualcomm is a much bigger company and so their revenue numbers are higher. But as you will see later, the story is quite different when we compare it on a per share basis. The same pattern is repeating for the net income. Qualcomm's net income increased by 276% and Skyworks by 79%. Both score a point. Again, both don't score any points for the quarterly numbers as their net income has started to turn down. The free cash flow is the actual earnings after investing in capital needed for the continued business operations. It is derived by taking the operating income and deducting the capital expenditures. An essential characteristic of a growing company is growing free cash flow. The bar chart represents the trailing free cash flow and the trend is growing. The line chart shows the free cash flow growth and the trend is pointing upwards for the most recent quarters. Both score a point each. On a per share basis, Qualcomm and Skyworks earnings per share has grown by 273% and 84%. Both score a point. Again, the quarter-on-quarter earnings per share is heading down, so both don't score any points. As mentioned earlier, notice that Skyworks earnings per share is 195, while Qualcomm, being the larger company, managed to earn just 153. I was curious whether is this reflected in the actual share price as well. And yes, Skyworks stock price has been higher than Qualcomm's for many years. The revenue numbers nicely dovetails to the price-earnings growth ratio or the PEG ratio. The PEG ratio is the stock price divided by the year-over-year revenue growth. It measures the rate of change in stock price compared to the revenue growth. If the price accelerates faster than the revenue growth, the number would be above 1. On the other hand, if the price has lagged relative to the revenue growth, the PEG ratio would be below 1. And this is what value investors look for. Both Qualcomm and Skyworks have a PEG ratio that is below 1 at 0.36 and 0.43. Both score a point each. Let us now compare the margins. Both Qualcomm and Skyworks enjoy a high gross margin at 56% and 49%. The 5G market is hot right now, and it is good to see that both can command such high margins. Both score a point each. Both companies also enjoy a high net margin at 22% and 27%, another point for each. But notice that while Qualcomm has a higher gross margin, Skyworks has a better net margin. I will explain the reason for this shortly as we go through the numbers. The quick ratio represents the ratio of total available cash and cash equivalents versus the total current liabilities. It measures the company's ability to service its short-term financial obligations within the next 12 months. A ratio of 1 or above is preferred. Skyworks Solutions' quick ratio is well above 1 and scores a point. Not only is Qualcomm's quick ratio below 1, but the trend is also pointing downwards. Qualcomm might have to take on more debt soon. Qualcomm has an enormous mountain of long-term debt at $15 billion, and Skyworks has zero debt. Furthermore, Qualcomm's debt has not been going down. Debt is an important financing instrument that allows companies to leverage and grow, but only up to a certain point. Qualcomm's long-term debt over total assets ratio is 41%. Skyworks scores another point. The effect of Qualcomm's massive debt can be better appreciated using this chart of interest expenses versus net income. Qualcomm's interest expense is $141 million versus net income of $1.7 billion. That is 8% of net income. As mentioned earlier, this is one of the contributing factors why Qualcomm's net income margin is lower than Skyworks. Qualcomm's operating income is partly reduced by payment for interest expenses. Skyworks does not incur any interest as it does not have any debt and scores a point here. Next up is valuations. At 18.7 and 22.9, both companies are trading at a decent price to earnings ratio. Both are profitable technology companies in the hot 5G space, so the PE ratios are fair, a point each for both. Price to book is the current price of each stock divided by the book value for each share. Value investors look for profitable companies that are traded below 5 price to book. But it is hard to come by, and you must also be very careful. Sometimes companies that the market has given up may end up with such low valuations. Skyworks Solutions scores a point here at 545 price to book. Let's tally up the scores. Skyworks is a clear winner with a score of 14 compared to Qualcomm's 10. Both scored well for growth-related criteria such as PEG ratio and year-over-year revenue growth. The key differentiator is Skyworks Solutions' zero debt level and price to book level. My preference would be to invest in Skyworks due to their potential growth, zero debt, and reasonable valuations. Subscribe to my channel if you have found this sharing useful, and hit that notification bell so that you don't miss out on any of my future videos. Do let me know if you would like me to do a video on any other stocks, and I'll see you soon in the next one.